Hey everybody, Ron Carruthers here. First off, let's see if you can hear me. Will you guys mark it in the box down there and let me know that this is actually working? We're trying a little bit of a new setup here. So if you guys could let me know, that would be great. Today we're going to chat about the 4 biggest risks that everybody faces in retirement. And I think you guys are really going to enjoy it. Even if you're young, even if you're in college, you got to check this out because everybody deals with this. But before we get to that, I will tell you this real quickly that if you need to chat about your situation and anything related to finance, taxes, retirement, college, hit us up. I'm not that hard to get a hold of, and if I'm not talking to somebody, they want me to do some real work. So shoot me an email. Let me know what's going on. I'd be happy to sit down and chat and see if there's something we can do about that. If you're not familiar with who I am, my name is Ron Carruthers. I work really hard to help my clients secure their retirement, pay less in taxes both now and in retirement, get their money right, as Uncle Grant Cardone talks about, and best of all, pay the least amount for college possible. So, but not the way you'd normally think it. So that's a little bit unique. Again, if you want to know more about what we do or if there's anything we can do to help, hit us up. It's no problem. But today we're going to chat about the 4 biggest risks in retirement. So before we get to what those are, we'll check it out. I'm going to show them to you real quickly. There's actually 5 of them. Yep, there they are. We're going to come back to those in a minute. I want you to think about this little story for a second. Imagine you've worked your entire life and you're getting ready to retire. You've been taking a paycheck. You've been diligently putting money into your 401ks, your IRAs, your SET plans, your 457s, your 403bs. You never touched the money. You scrimped and saved the entire way. And now you're retired. And 2 things happen. The first is your paycheck's gone, like gone, never to return again. Now you might have Social Security coming in or a teacher's pension or something like that. But not only is the money gone and not coming back, now that nest egg that you've built over 30, 40 years, you have to go through and start spending that money. And it's really nerve-wracking for a lot of our clients because it's so, I'll use an SET word for you guys. It's anathema. It's a fancy way of saying the opposite. See, I took some classes in college. I knew what's up. It's anathema to what you've been doing for the last 40 years. Interestingly enough, Harvard did a study that showed, it's from the Harvard Business Review, that the people who were the happiest were people who had some sort of guaranteed predictable income, just like that paycheck. So with that in mind, let's chat about the biggest risks to your retirement. Here's what they are. The first one is longevity. And it simply means that you outlive your money. Now, you may not think this is a big deal, but let me give you some statistics. If you and your spouse, I'm going to read these to make sure I don't screw them up. And by the way, people think the biggest risk they're going to face is market risk. That's the second biggest risk. The biggest is longevity, outliving the money that you have. So if you're a male and you're 65 years old right now, your expectancy is 85 years old. A female who's made it to age 65, her life expectancy is now 87. And if they're a couple, their life expectancy together is age 92, and there's a 5% chance that one of them makes it to age 100. So now if you leave and retire at age 65, the odds are that you will have 27 years of retirement. That one of you will be alive for 27 years, and you might live longer than that. That is the number 1 retirement killer there is just plain old age, and it compounds all the rest of your risk. What do you mean? Well, now the money needs to stretch out over a longer period of time. which makes you more subject to market risk, inflation risk, and sequence risk, which I'll explain in a moment, which are the other three big risks. And it exposes you more to taxation risk, which is the fifth one that's not on my thing. So it's a multiplier of all your other problems. So let's explain market risk. That one everybody kind of seems to get. Basically, a person's retirement success is very dependent on how their portfolio performs in the 3 years before retirement and the first 3 years of retirement. If anything bad happens in there, your chances of having your money last for the rest of your life increase substantially. Now, so that's a big deal. And what I see, a lot of my clients come to me because they're really concerned, particularly with what's been going on in the market in the last few weeks and few months. We had the market's gone up for 9.5 years, and all of a sudden, October, November, December, it's coming down. It goes back up the last week or so, coming right back down again. Again, if you want to chat about any of this, hit me up, shoot me an email, we'll get you in. I don't want to do real work, write books, handle stuff. I want to chat with you guys, so you got to hit me up. The third risk is inflation. And let me give an example of what that looks like. The longer you live, the more expensive stuff gets. People get that intellectually, but they don't get it in their heart, what that really means for them. And let me give you a perfect example. Stop and think. In fact, write it in the comment box. What's the lowest you ever remember seeing gasoline? If you're watching this later, I'll come back and comment on it then. And let me know the lowest amount you've ever seen a gallon of gasoline for. And right now, as I record this, one block over, there's a Shell gas station, and it's down to $4.11 a gallon. If you guys are in other parts of the country, you have no idea how good you have it versus California. It was $4.19 when I gassed my car up there the other night. Now my car does take premium gas, but $4.11 it's down to. I remember gas 75 cents a gallon. And so that was the early 70s. So think about how stuff just gets more expensive over time. That's inflation risk. Cars are going to get more expensive when you need to replace them. Groceries are going to get more expensive. Healthcare is going to get more expensive. That's a big deal. So all of these compound and put pressure on what you're doing retirement-wise. And then the fourth one that I'm listing here is sequence of return risk. Big money management company did a study, kind of like a white paper, that showed that if you went and had the exact same sequence of returns, they took two families that had two different sequence of returns. They were the exact same average rate of return. When you're accumulating money, 8% accumulated average is the same. Whether you have good years early, good years late, bad years early, it doesn't matter on any of it. But two families can have that same 8% average return. But this company did this study showing they had the exact same 4 years just repeated. One had the best year first, then the second best year, then the third best year, then a negative year. The other family had the exact same thing, but in reverse. And taking the same money out, one ran out of money 13 years earlier than the other family did. It comes back to what I was telling you. Those 3 years before, the first 3 years after your retirement are kind of like the leading indicators of how well you're going to do. So now the question becomes, okay, oh, by the way, the fifth risk is tax risk. And it simply means if you worked hard to put all your money into a 401k, man, my chair's uncomfortable. If you worked hard to put all your money into a 401k, now you're going to be required to take required minimum distributions when you're 70 and a half. Again, you're into that weirdness of you saved and saved and saved, and now you're going to start taking. Here's the problem there. You are required to take it at whatever rate they tell you. So when you're deferring money that you're putting a 401k on, you're deferring the tax and the calculation of the tax. This becomes a problem. You want to chat about alternatives? Well, I guess that was that. It took my desktop screen right out. Next thing ready here. Let's see if I can share this one with you guys. Whoops. Let me see if we can do this. Will you let me share? Come on, baby. So now taxes, which the government has told us, the young Democrats in Congress have told us they're going to be raising the minute they get into office. That's like the worst sales pitch ever, right? It's like me telling my wife, yeah, baby, I'm going to marry you for better, for worse. And the minute we get married, I'm going to put on 50 pounds and I'm never going to bathe and I'm just going to sit on the couch all day. Like telling you up front, we're going to raise your taxes and make you pay 70% or 90%. That's a problem. So if you're still in your early years, hit me up, shoot me an email if you want to chat about alternatives for your situation. I've got different reports I can put together. Most of them we don't even charge for. Really, the only piece that we charge for is the college piece. So it's a free consultation. Hit me up and let me know on that. ron.carruthers@roncarruthers.com. But anyway, back to this. You can avoid some of that taxation risk by going through and planning ahead. Now, if you're already in it, we actually sit down with our clients and do what's called an IRA rescue, where we very strategically figure out when we're going to take this money out, if we're going to convert to Roth IRAs, if we're going to convert to a 7702 plan. That may not mean anything to you. What it means is you pay less taxes overall, because that's another risk you face. Now, what are your alternatives to these things? Well, there's three different methodologies for hitting up your retirement. The first is what they call the 4% rule. I'm going to go into that in another video on that and why that no longer works. For today's purposes, we're going to talk about the flooring methodology and why you want to floor your expenses. And all that means is that we go through and figure out your baseline expenses, figure out what's covered by Social Security, what's covered by any other pensions that you have, and we cover the rest with an asset-backed pension. What's an asset-backed pension? You ask. It's the same as Social Security or regular pension. The difference is it adjusts every year for inflation. It goes as long as you or your spouse is alive. If you're married, you can't outlive it. It continues to increase to offset that inflation even after you've exhausted all your money. And we just use it. You exchange money with a special type of investment company, your cash, for this pension. And the reason it works so well is now we've removed those 4, 5 risks. We can't get rid of tax risks, but now you can no longer have to worry about outliving the money because it's going to go forever. You no longer have to worry about the market because your payment, your money that you receive goes up. It can never go back down. You don't have to worry about inflation because it's built into it. And you don't have to worry about the sequence of returns risk because we've removed that from the equation. By the way, Towers Watkins did this study, and all we want to focus on is the red there. And it just shows people that had guaranteed income across the board were happier than people that didn't have guaranteed income. That's it. That's all it says. So those are your 5 big risks. We want to help you mitigate those. So again, we do more than college. I work really hard to be the smartest guy you know when it comes to paying less taxes, securing your future, and yes, paying the least amount possible for college. So if you have any questions about this, about those 5 areas, longevity risk, market risk, inflation risk, sequence of return risk, or tax risk, hit me up, ron.carruthers@roncarruthers.com. Shoot me an email or just throw a comment down here and I'll reach out to you. We'll set a time to chat, see if we can straighten you out a little bit like we do for a lot of our other clients. So that's your class for today. I'm going to go ahead and shut the machine down and I am off to watch hockey. It's going to be glorious. I will chat with you guys again tomorrow. If you like this, hit the like button. I don't know what it does, but I've been told it's really good if you hit the like button, and feel free to share this with your friends. So I hope you enjoy it. And if you have anything you want to see me do, hit that in the comment. Don't forget to write down what's the least amount you remember seeing gas for in the comments. We'll do it again tomorrow. Take care, you guys. And let's get this bad boy shut down so Ron can go watch some grown men smash into each other. I believe that's it.